Welcome to the deep dive. We've got the latest market intelligence report on Bitcoin here. And today, our mission really is to cut through all the noise and figure out Bitcoin's path in what feels like an increasingly chaotic macroeconomic environment.
It really is the key conflict right now, and it frames this whole deep dive. We are seeing, I think, a genuine decoupling.
Decoupling, okay.
Yeah. Those long-term structural adoption drivers, they're starting to seriously outweigh the short-term macro stuff, the political uncertainty, everything coming out of D.C.
And wow, what uncertainty it is. We definitely have to touch on the immediate backdrop. October 1st, the U.S. government officially shuts down.
Right.
But looking at the market, the reaction seemed, well, surprisingly quiet, didn't it?
Exactly. Muted is the word. The market basically treated the shutdown like temporary political drama, not some systemic event requiring everyone to sell off assets.
So it wasn't seen as a major risk.
No. And because of that, attention snapped right back to Bitcoin's own fundamentals.
And those fundamentals seem to have pushed the price up. Bitcoin broke above $114,000. That's a key psychological level, technical level too. And right now it's testing resistance up near, what, $116,500? Almost a 2% gain in 24 hours.
That's right. And it's constructive movement. As we'll get into, it's backed by pretty solid on-chain data.
Okay, let's unpack this then, because it seems counterintuitive, right?
Yeah.
How is this asset, often seen as a hedge against chaos, actually rallying right into the middle of it?
Yeah.
Let's look at those confusing signals from the traditional economy that Bitcoin seems to be ignoring.
Well, Washington's giving off these twin risks, but the shutdown itself, that was shrugged off, like we said.
Right.
The main risk now, the one to really watch, is the data drought. It calls it.
Drought.
Yeah. Government closure means delays for crucial reports. Think non-farm payrolls, CPI,
Sure.
the very data the Fed and the markets rely on.
Right, so an information vacuum. That creates huge uncertainty for policy, doesn't it?
Absolutely. Policy paralysis. And just before everything shut down, we got these wildly conflicting economic reports. It's almost dizzying.
What were they?
First, you had a strong inflationary signal. The Joel Test report showed the labor market is still tight. Job openings stuck around 7.2 million. That was actually higher than expected.
Suggesting things are still running hot.
Exactly. Overheating, potentially. But then almost right after, boom, a recessionary signal.
Okay.
The Conference Board's Consumer Confidence Index, it plunged to 94.2, and the part that looks forward, the expectations bit, dropped to a level that historically usually means a recession is coming.
Wow, so it really feels like the economy's got one foot slamming the gas and the other hitting the brake. Economic whiplash.
That's a good way to put it. And if you connect this to the bigger picture, this conflicting data just pulls the Fed in opposite directions.
Okay.
Do they keep fighting inflation, hold rates steady, or do they worry about recession and start cutting? It creates maximum unpredictability in traditional markets.
And I guess this really underscores Bitcoin's value proposition, right?
Exactly. While traditional markets are kind of flying blind because of political games and delayed data, Bitcoin's core data, hash rate, transactions, supply issuance, it's all real time, it's auditable, it's completely immune to DC drama.
So you're saying it's the difference between waiting weeks for a potentially stale government report versus checking the network health, the hash rate, instantly.
Precisely. When visibility drops everywhere else, that auditable real-time reality becomes incredibly valuable. It wins.
Okay, but let's drill down into the why behind the price move. Where's the actual capital coming from? This resilience isn't just sentiment. You're saying it's backed by, well, big programmed money flows.
It is. And the corporate treasury idea, it's picking up steam globally and becoming much more sophisticated, I'd add.
How so?
Well, look at Metaplanet Inc. Japanese company, publicly traded. They just announced another buy 5,268 Bitcoin for $623 million.
Wow, that's a huge number.
It's monumental. That single purchase makes Metaplanet the fourth largest publicly traded corporate holder of Bitcoin globally.
Fourth largest globally. That's significant diversification outside the usual U.S. tech names. And crucially, you mentioned sophistication. It's not just about holding.
No, exactly. It's not just sticking it on the balance sheet. Metaplanet also revised its earnings forecast upwards. Why? They cited a massive 115.7% quarter-over-quarter jump in revenue from what they actually called their Bitcoin income generation business.
Bitcoin income generation.
Yeah. And the strategic importance here, you really need to grasp this. This isn't just hoarding. It shows these big institutional players are figuring out how to make Bitcoin actively work for them.
Making it generate cash flow.
Exactly. Passive cash flow for shareholders. Turning a store of value into a productive yield-generating asset, That fundamentally changes the investment case for many.
And speaking of systematic buying, Tether. We have to talk about Tether.
Always. On-chain data confirms it. Tether, the USDT issuer, bought another 8,888 Bitcoin, worth about $1 billion. And this is just them following their stated policy, right? Allocating 15% of their net profits back into Bitcoin reserves.
So their total holdings are now?
Estimated close to 109,410 BTC. It's massive. And it creates what you could call a crypto-native treasury flywheel.
Explain that flywheel concept.
Well, think about it. The growth and success of the whole crypto ecosystem heavily relies on USDT for liquidity, right?
Absolutely.
So as crypto grows, Tether profits. And those profits systematically fund these large, non-speculative Bitcoin purchases. It's structural demand, and it's inherently insulated from whatever mood swings are happening in traditional markets.
Almost 110,000 Bitcoin. Just put that number in perspective. That's a huge amount of potential selling pressure that this systematic buying can just absorb, isn't it?
It acts as a really strong underlying bid in the market, a stabilizing force. And look, we're seeing this corporate treasury idea spread internationally, too. Even to smaller companies, even in places with maybe more cautious regulators.
Like where?
Like the UK Trust Spine Technologies, Pleiade, a UK-based firm, just announced they intend to hold Bitcoin in their treasury reserves, too.
Interesting. So it's not just the big North American players anymore. The thesis is migrating.
Definitely migrating.
Okay, so the money's flowing in. We see that.
Yeah.
But what about the charts, the quantitative side? Is this rally built on solid ground, technically speaking?
The structure looks pretty sound, actually. Technically, Bitcoin got back above its 20-day and 50-day exponential moving averages. That 50-day EMA, think of it like the market's medium-term pulse. Getting back above it is a pretty bullish sign.
Okay.
But the key focus right now, the immediate hurdle, is that overhead resistance zone, roughly between $117,000 and $118,000.
Right.
If we see a sustained break above that zone, that would really signal continuation, confirm the momentum.
And underneath the price action, what about conviction? What are the actual holders doing on chain?
Well, the analysis confirms we had what looks like a healthy reset during that last dip in price.
A healthy reset, meaning?
Meaning we saw the short-term holders, typically the newer folks, the more speculative crowd, they did capitulate, they sold.
Okay, so panic selling from some.
Some, yes. But here's the crucial part. The long-term holders, the HO dealers, the ones with deep conviction, they barely flinched. They remained completely inactive and basically just soaked up all that supply the STHs were selling.
So the weak hands sold, but the strong hands just bought it all up. That definitely confirms conviction is still there deep down.
Absolutely. And adding to that picture, we're still seeing consistent negative Bitcoin net flow from the major exchanges. Binance, for example, averaging about negative 311 Bitcoin leaving per day over the last month.
Which means coins are moving off exchanges, presumably into cold storage. Less available supply to be sold on the open market.
Precisely. Reduces that immediate sell pressure. And this leads us straight into the derivative setup, which looks interesting. It suggests the move through that 117K, 118K resistance could actually be quite explosive.
Explosive. Why? You mentioned a liquidation cluster. What is that exactly, and why would hitting it trigger a big move up?
Right. So a liquidation cluster is just a dense concentration of short positions, bets that the price will go down.
Okay.
These positions are often set up with automatic closure triggers. If the price hits a certain level, their broker forcibly closes the position to limit losses.
They're forced to buy back.
Exactly. And right now, there's a large cluster of these short liquidations sitting just above the current price, between, say, $118,000 and $119,000.
I see.
So if Bitcoin pushes through that 117K resistance, it starts triggering these forced closures. Short sellers are forced to buy Bitcoin back immediately to cover their positions.
Creating a cascade of buying pressure.
Precisely. That forced buying is what we call a short squeeze. And it can add serious fuel, dramatic upward momentum to an existing rally.
So that technical resistance level isn't just a ceiling. It could be more like a coiled spring waiting to release upwards.
Could be. The setup is certainly there.
Okay. Fascinating. Now, beyond price, beyond corporate treasuries, the utility aspect seems to be really taking off too. We're hearing a lot about layer 2 solutions, L2s. It sounds like a whole ecosystem is blooming there.
Oh, absolutely. This is one of the most exciting and, I think, transformative long-term drivers. Take Starknet, for instance.
What are they doing?
They just launched something called BTC-Fi Season. Basically, they're putting up 100 million of their SDRK tokens, that's worth about $12 million right now, as incentives.
Incentives for what?
For trustless staking of wrapped Bitcoin on their network.
Trustless staking. Okay, unpack that. Why is trustless the key word there?
Because it allows Bitcoin holders to put their BTC to work, participate in DeFi, earn yield, crucially without giving up custody of their underlying Bitcoin to some third party.
So you keep your keys, keep your coins, but still earn yield.
Yeah.
That's a game changer, isn't it? It shifts Bitcoin from just being passive gold
To being productive infrastructure.
Okay.
Exactly. It makes the asset work. And we're seeing real specialization emerge among these L2s now.
Specialization how?
Well, look at the introduction of BTCLE. Stands for Bitcoin Layer 2 Limited, its specific design goal. Bridging real-world assets, RWAs, onto the Bitcoin network.
Real-world assets like tokenized real estate,
Yeah.
tokenized bonds, that kind of thing.
Precisely. Things like that. And notice their tokenomics. Extremely conservative, tiny hard cap on their governance token, a long 10-year vesting schedule.
That definitely sounds like it's designed to appeal to serious conservative institutional capital, not quick slippers, aiming for stability and security.
Exactly right. It screams institutional grade. And you contrast that specific focus with other L2s, like BOB, right? BOB is focusing on EVM compatibility.
To tap into the big Ethereum developer community.
Exactly. Or you look at Bitcoin Hyper, which is integrating the Solana virtual machine, aiming for super high transaction speeds.
So it's not one size fits all. The L2 landscape is becoming modular, specialized, almost like different flavors of cloud computing infrastructure built on Bitcoin.
That's a great analogy. It's evolving into this highly competitive modular settlement layer.
That architectural shift feels really significant. And even the mining sector, it's not just about adding more hash rate anymore, is it? There's strategic evolution there too.
Definitely. Maturing beyond just brute force hashing, the focus is shifting towards efficiency, sustainability, innovation, really.
Like what?
Like the development of thermoelectric technology. This is clever stuff. It captures the massive amount of waste heat that mining rigs produce.
Yeah, they get incredibly hot.
Right. And this tech converts that waste heat back into usable electricity.
Wow, recycling the heat energy.
Exactly. It doesn't just make mining greener by reducing the footprint. It actually maximizes the efficiency of the power you're already paying for. Creates a more circular energy system right there in the data center.
That's smart. And on the corporate finance side of mining, we're seeing more discipline there too.
We are. Professionalization. The CEO of Bit Digital, for example, recently put out a strong warning. He cautioned miners against using secured debt.
Where the crypto assets themselves are the collateral.
Yeah. Because in a bear market, if prices crash, you risk getting liquidated on that collateral. It can be crippling. He's advocating for safer structures like unsecured debt, maybe convertible notes.
Right, more traditional financing methods.
It signals the sector is adopting that traditional institutional rigor.
Yeah.
Managing balance sheets properly, moving away from some of the riskier crypto-native financing experiments of the past.
Okay, so wrapping this all up, what's the big picture takeaway here? It feels like a powerful convergence.
It really is. On one side, you've got this systematic, programmed buying, global companies like Metaplanet, crypto giants like Tether, just consistently accumulating.
Steady demand.
Steady structural demand. And on the other side, you have this explosion in technological utility. L2s like Starknet, BTCLE, fundamentally changing what Bitcoin is and what it can do.
Transforming it.
Transforming it. So it means that decoupling thesis, it's not just theory anymore. You can see it happening in real time in the data.
So while the macro picture is messy, the shutdown, the confusing Fed, signals creating volatility.
Right, that creates the noise, the short-term chop. But the big, well-funded players, they're looking at any price dip, not as a reason to panic sell, but as a strategic chance to buy more.
An accumulation opportunity.
Exactly, an opportunity to accumulate a scarce, increasingly productive asset.
Which leaves us, and you, the listener, with this final thought to chew on. We see these specialized L2s like BTCLE being built specifically to tokenize real-world assets on Bitcoin. We see initiatives like Starknet turning Bitcoin from passive collateral into a yield-generating asset through staking. So the question is, how long can traditional finance ignore this? How long until they're forced to see Bitcoin not just as digital gold, but potentially as the foundational security layer for a whole new global tokenized economy?
And what kind of valuation model does that reality demand? It's a profound question.
Indeed it is. We'll be back tomorrow to track where the market takes us next.